Hey everyone, today I'm going to talk about um, the supply curve and why it might shift, and then we'll see how we might graph a shifted curve. So first, let's talk about what the supply curve is. The supply curve is right here in blue. Um, the supply curve for any graph is just the aggregate supply in a market. So for example, something that might be common in the United States is the market for fast food hamburgers. For fast food hamburgers, the supply curve would represent the quantities of burgers that any restaurant in the area would supply at any given price. And so you could imagine if you wanted to make a real supply curve for fast food hamburgers in your area, you could go to every restaurant that sells fast food hamburgers, and you could give them a little survey. You could say, here's the price from $0 to $10. Please write here how many hamburgers you would be willing to supply in a day at every given price. And every business owner could fill out your survey, and then you could go back and actually calculate how many burgers in your area would be sold or would be supplied to the market at any given price. So that is what a supply curve represents. It is all the supply in a given market, and there's really infinite markets. A market is can be defined as anything. So let's talk about a few reasons why the supply curve might shift. There's actually five reasons, five main factors that we learn in the classroom that might shift the supply curve up or down. The first factor is that the price of other goods might change. This is especially true with related goods. Going along with the fast food hamburger example, let's say that that pizza is a competing product to fast food hamburgers. If the price of pizza suddenly gets cut in half, for example, maybe there's just so many more pizza businesses or pizza restaurants in the area that there's so much competition that the price of pizza just gets cut in half. Well, a lot of the machinery used to make pizza is pretty common in the restaurant industry, and could probably be applied to making hamburgers pretty easily. So a lot of that machinery and equipment might be transferred over to the hamburger market because those business owners, as the price of pizza declines, they want to make more money, and they see opportunity in the fast food hamburger market, so they switch over. That would actually cause the supply curve to increase at every given price point, since there's more suppliers in the market. There would be more quantity supplied at every price point. And that actually goes on to the second factor is the number of sellers. As the number of sellers increases, the supply is naturally going to increase at every dollar or at every price point. There's going to be more supply in the market just because of the number of sellers. A third factor is the prices of relevant inputs. If the cost of the resources used to produce the fast food hamburgers increases, then sellers will not be willing to sell the same quantity at that price. For example, if wheat flour that is used to make hamburger buns, if the price doubles, sellers might not be willing to supply 30 hamburgers at $3 anymore. Maybe they're only willing to supply 20. And so that would cause the supply curve to definitely shift down. A third factor is the technology. Advances in technology makes things cheaper. That would shift the supply curve to the right, because there would be more supply at every given price point. The fifth factor is expectations. If sellers expect prices to increase in the future, they might start producing more in advance, so that they can be ready to make the profit from those higher future prices. And that might be more applicable in the market for something more durable and not perishable, maybe houses or refrigerators or ovens. But let's go here and describe a little more how we can shift the supply curve. Okay, here we go. So let's shift the supply curve up and then shift it down again, and then we can talk about that so we understand what's going on. When we're going to be dealing with multiple curves, I like to put a zero after the original curves. So supply zero will be the original supply curve before the shift, and demand zero will be the original demand curve before the shift. So to shift, let's make one new supply curve. We can call that supply 1. And then let's make another one just called supply 2. We can shift it 2 times. So for supply 1, let's say that the supply curve shifted up, and let's say that going along with the fast food hamburger example, let's say that sellers of fast food hamburgers are willing to sell 10 more at every price point. So we can actually just go in and add 10 we can add 10 just to every point on the previous supply curve. So if so for example, at $8, sellers were willing to supply 80 before, now they're willing to supply 90. On here you can see that this is the original supply curve. Before we were willing to supply 80. Now at $8 we have to go all the way over here, and we're willing to supply 90 hamburgers to the market. We talked about some reasons that might happen, but let's talk about that again. Maybe the price of competing goods like pizza declined, and businesses are switching over to the hamburger market. Maybe the numbers of hamburger restaurants in the area increased, and so you'll see more supply at every given price point. Maybe the prices of hamburger ingredients went down, so we can lower our prices. Maybe technology increased. Maybe we have robots making the hamburgers now really cheaply. And maybe expectations of sellers doesn't come to play as much with perishable goods, but maybe restaurant owners think that the price of hamburgers is going to decrease soon. So they'll start producing more so that they can still make the same amount of money. And then let's also shift the curve down. And on a graph like this, increasing the supply curve or shifting it up is really shifting it to the right. When we shift the supply curve to the right, you'll see that at $1 before the quantity supplied was 10, now the quantity supplied is 20. At $5 before the quantity supplied was 50, now at $5 the quantity supplied is 60. So shifting the supply curve to the right means an increase in supply at every given price point. Now we're going to shift the supply curve to the left, or decrease the supply curve at every given price point. And we won't shift it to 0 because we can't supply negative. So we'll just put 0 there again. But we want to take our original supply curve and let's just do the opposite. Let's subtract 10. So if I'm a business owner, I'm going to be willing to supply 10 less or 10 fewer hamburgers at every given price point. So at $3, when I originally, if I was a business owner, if I would originally have supplied 30 hamburgers at $3, now I'm only willing to supply 20 at $3. And this could be the opposite for the opposite reasons that we had talked about before. Maybe the prices of competing goods are increasing. For example, if I'm selling hamburgers, if the price of pizza doubles, I'm going to want to start selling pizza now. And so I'm going to be selling fewer hamburgers because there's not as much profit there. If going along with that, if the number of sellers in the market decreases, say they're all making pizza now, there are going to be fewer hamburgers in the market because there's just fewer people selling them. If the prices of hamburger ingredients increase, I'm going to have to raise my prices. So that means at $3, I'm going to be willing to make fewer hamburgers because my costs went up. For technology, technology doesn't really decrease. Once you have technology, you really have it. But let's say that the power goes out and you can't use a power mixer, and you have to mix the dough by hand to bake the hamburger buns. In that case, since it's so much more labor intensive, you would be willing, or you'd have to raise your prices. That means that at any given price point, you are now supplying fewer hamburgers at that price. For expectations, if sellers expect prices to increase in the future, sellers might decrease the quantity that they supply now in order to be able to supply more later. And I'm sure you can think of more supply shifters, but those are the main ones that we talk about in school. If you have any questions, if you want me to clarify anything, leave a comment below. I will paste a link in the description so that you can download this file if you want to take a look at it more. If you have any questions, just let me know. Thanks for listening.